Anand Shah joins us, represents ICICI Prudential AMC. Let's understand his market take. What is he betting on? We'll flash what public information which we have, his latest portfolio, which includes banks, L&T, Bharti Airtel, SBI, and very interesting metal names actually, Sharda Energy, Godavari Power. We'll talk about some of those themes, ideas, and what is he bullish on. Anand, good morning. Thank you for joining us. There are a lot of beliefs in the market, they are getting challenged, which is that HDFC Bank will always do well. FIs will always continue to buy into India. Banks will continue to grow and there will be no NPA problems. The start for this year, or start for the year, has been slightly shaky. Markets are now reacting in extremes. Bad reaction, the stock is getting pummeled. Good reaction, the markets are rewarding that stock.
Hi, Nikunj. Very good morning. And yes, I think overall, as we've been all observing, markets on an aggregate basis is very strong. But what has changed, and that's what we've been talking about, there's a trend change that a lot of things did very well between 2010 and 2020. At the same time, a lot of businesses did very badly. And the common factor there was that there was an export of deflation from China. And to that extent, consumers of goods and raw material, like the B2C businesses, did very well between 2010 and 2020. But a lot of these manufacturers did very badly, so much so that within banks also, if you see, the retail banks were resilient, but the corporate banks or the banks which lent to manufacturing allied businesses like utilities and others suffered a lot in terms of NPAs. I think that trend has changed from 2020 to 2023, even into the first month of 2024. If you see, there is a stark difference between the results of the B2C businesses, which are doing extremely well. They are coming under pressure, be it margin pressure, volume growth pressure. Whereas B2B businesses, which have survived 2010 to 2020, they are having sigh of relief. They're doing overall better. Even within the banks, if you see, there is more recoveries from corporate accounts and very little NPAs. But the retail side, we are seeing early signs of some stress, and obviously RBI is also sort of watchful on the same.
And if one looks at the numbers, what we got from SBI cards, that is a clear indication of which way the retail borrowing trends are actually moving. So put in perspective for us, what does that mean for markets and what does that mean for banks? Because most of the banks now, they take a lot of pride in saying that we are getting more than 60 to 65% of our fresh loan growth book from retail.
So again, the retail overall is also a breakup of many things. Housing loans are doing extremely well. The secured loans are doing extremely well. I think if we hear from RBI, within the personal loans, within the unsecured loans also, there are only pockets where they are worried. It's not that generally all the unsecured loans. So to me, there has been series of benefits that have come to the banking industry. On the corporate side, we had IBC. On the retail side, we had SurfaceE, which is helping on the housing loan. The slippages are fairly controlled, and more recently, the CIBIL scorecard. So this is helping many banks to actually continue to lend to retail in a conservative fashion. So I think again, there's no 1-0. We will have to look through the segments that you're in lending to, and within what strata of the society you're lending to, where are the stresses. So a lot heterogeneous. I don't think there is one answer that all the retail loans are under stress.
Sure. So, Anand, moving away from the world of financials, where do you think when the FI money returns is going to find its way? Because for now, it seems that FIs have clearly been eluding us. It's been a DI-led market. But clearly, it's not banks where, money is going to move in, perhaps, and looking at the fundamentals as well. Where else are they going to park their money then within the large cap pool?
So again, it's an interesting study we did, and when you see the top 100 companies, the so-called large caps within the markets, they are dominated by consumer-facing businesses, financial services, pharmaceuticals, or for that matter, telecom and services, IT services. A lot of very little of manufacturing and manufacturing allied businesses have survived in the top 100. They have all gone below top 100, and that's where we are seeing incremental earnings growth is better and valuation is also very comfortable. So we are not surprised that there are pockets in the mid caps and small caps which is continuously attracting investors' attention, given that they're doing well on the earnings front. At the same time, the valuations are not very demanding. I think what we are observing, and again, this is no data with me, but even within the FIIs, while we are seeing continuous selling, but there is a selective buying within mid caps and small caps within manufacturing and allied businesses. I think that's where the flows that we study on the FIIs is showing.
So if I have to put a very simple question, where is value in this market? How would you address that?
I wish this is an interesting market. We don't have value per se. At the same time, there are enough earnings growth, which is not making the market very expensive. So I think it's a difficult market to call the macro way. But at the micro level, we continue to maintain our stance, which we have been maintaining for last 3 years, that there are select companies within the manufacturing space which survived 2010 to 2020, and today, the world needs it. Not only India needs it, because now no more China will be the factory for the world into the future. Slowly and steadily, there should be a decline uh, of, of manufactured goods exports from China, and the world will need an alternative. And I think India's own consumption also, we are looking at more Atmanirbhar, more, I would say, import substitution. So I think there are pockets in manufacturing, and then the allied businesses which support this manufacturing. Our portfolios are overweight there. Notwithstanding, they've done very well for last 3 years, but the earnings growth has supported that, and to that extent, valuations to us again, not generally for the sectors, but for the select stocks that we own are under demanding, and that's why we continue to maintain the position.
You've taken a big bet in metals, and metals are a global dominated sector. It does not matter what India does. What matters is that what world does, and world is not in a good shape. So, what makes you bullish on metals? Is this more like a tactical trade?
Actually, on the contrary, metals is more today investor. We are in the investment mode. We are not normally metals. You find people taking tactical calls, given it's very cyclical in nature. But I think there is a structural play here where we believe China, which is the largest manufacturer as well as the largest consumer of metals, should slowly and gradually step back. I think last year had been very difficult. We had the largest consumer of metals, which is China. We had massive slowdown there. And to that extent, it's not a great year for us. And for that matter, in the metal stocks last 1 year. But when I compare the results for 2023, FY 2024, compared to the last time when we had such a difficult situation in metals, I think they're different. And to that extent, that gives me that we will make higher highs and higher lows in terms of the profitability for these metal companies. They have deleveraged, they have become stronger, they can withstand the slowdown the way they have withstand without being significantly under stress on the balance sheet point of view. So I think we are hopeful. India has a right place. We own raw material. We have capability to manufacture metals, and to that extent, as China takes a step back, as they focus more on environment, on green, lower emissions in their own prosperous parts of their nation where they manufacture all these metals, I think slowly and gradually we should see more stable environment for metals in times to come.
Hi, morning. Let's also get in your outlook then as to what your expectation is when it comes to the FII flows. Do you believe that going down the line there are going to be some particular pockets or area of interest where we will see the FIIs pour money into?
I think it's dependent a lot more on the direction which the US interest rates take. Very clearly, last couple of years have been tough. The US dollar returns have increased substantially, and to that extent, there would be obvious flows out from emerging markets into the US world and from equities to the debt, given that now US dollar itself earns a lot more. So it depends a lot. But I think the good news for Indian equity markets have been domestic investors, and within that, the SIP investors. I think that's much more stable money. We feel that generally SIP investors, provided they stay for a certain period of time, have a very pleasant experience, and to that extent, they remain into the markets for a very long term. So I think what the Indian mutual fund industry and its participants, the distributors have managed to do is to teach the Indian investors to gradually invest and be investors into the markets. I think if this continues, this is a very good supporting factor against any volatility in the FIS flows.
And really appreciate your time. So glad you could join us with your inputs and with your thoughts.